Ladies and gentlemen of the crypto space, we're live on a Friday, February 23rd at 11:34 a.m. There's a lot of terminologies that are flung at you from the crypto space. And it's not as hard as most people think because you need a comparison. When you have a comparison, something to relate to, you're able to put things into perspective, to understand them, to find the common denominator, the idea or concept that's shared between what appears to be very different things. Now, obviously, today's title is the fee switch, and we're talking about Uniswap because that's why there's a 50% candle on Uniswap on the day. A fee switch, if you go on any stock ticker, is a yield. And the price of a crypto asset is akin to the price of a stock. So whether you're talking about stocks or crypto, you have the price and a yield. When you have a price and no yield in a stock, you have just a bullshit stock. And when you have a price and no yield in crypto, you have a governance token or a gas token. Now, in the world of the 2010s, where it was 0% interest rates and malinvestment or the capacity of the average investor just rapidly fell off a cliff, and nobody really knew what an investment was other than the price of the stock going up or the price of the gas token going up, because we sure as hell had that in the crypto markets in 16 and 17. ICO season, or even just dog coins and whiff coins and meme coins in crypto markets, the general public, the average market actor, is still in that gambling mentality. In an age long ago, in a galaxy far, far away, there was a concept of inspecting a balance sheet and making a rational investment choice. In equities land, you got a whole lot of shit to look at. You got the debt load, you got the cash flow, you got the research and the reinvestment. And more recently, in the last couple of decades, you have the concept of buybacks, which is reinvestment of sorts, and a monetary policy, if you will, in crypto language. Then you have salaries and human resources and expenses, OPEX and CAPEX, a whole bunch of bullshit. And everything that was left over would be voted on by the board to give a dividend to the stockholders. Oh, here you guys go. Here's the leftover shit after we took our $45 million CEO pay packages, and you know what I'm saying there. So crypto markets change a lot of the equation because there's no real estate, there's no human resources. Uh, there's accumulation, and for many protocols, so obviously it's not clean cut. There's obviously still things to inspect, different things, many different considerations, many similarities, but generally, most like deterministic and immutable protocols have no salaries, the concept of a salary, or the concept of real estate for offices, so on and so forth, or health insurance, human resources associated expenditures. Um, so it's a very different type of balance sheet to inspect. So you still have the price point. You have the price of the stock. You have the price of the coin. You have the yield of the stock, the leftover shit that the CEOs and the board want to give you. And then you have the yields in crypto markets. Y'all are familiar with the percentage sign. You see a lot of percentage signs in the crypto markets. Oh, how much yield is it offering? Juicy yields it's offering. So LP is another story. There's a percentage there, but obviously from a governance asset perspective, when you have a governance token of a protocol, and the protocol offers products and services, credit, leverage, derivatives, LSDs, so on and so forth, stablecoins. Um, the protocol is quite often designed to accumulate revenue, charging interest, and distributing that interest to the relatively centralized governance asset, the holders of the governance asset. That's clearly very common, and that's what Uniswap has been discussing since the age before time, which is only 4 years because that's when all of this started. And plenty of protocols offer it as well. And that's why there's a 50% rip off the bottom. But, what I want to do, and what I often do, is tell you guys where this all ends. Because it all ends in the same place, always, because it's all the same thing. Yield is a percentage sign, and a percentage sign is a percentage sign, and that's all it is. Meaning, if you're getting 20% on Uniswap when they turn on the fee switch, or you're getting 20% on Aave, or you're getting 20% on Curve with rentals and fees, or you're getting 20%, 20%, 20%, wherever you're getting 20% from, it's 20%. You're not going to make more if you're getting it from one place versus another. 20% is 20% is 20%. So this is the first mistake people make with regard to over diversifying a protocol or a portfolio. It's still a little sick. So where does that leave me thinking? This is interesting. Why? I don't need to own Uniswap for 20%. I got plenty of protocols that are paying 20+%. Whole portfolio is a construction of protocols paying 20% plus yields. But Uniswap is very well known to be a Lego. So protocols build on Uniswap. In fact, the vast majority of almost all of the financial activity, all of the volume on Uniswap is not from the Uniswap portal. It's from protocols that plug into the liquidity available on Uniswap. So these yields end up circulating through the system. So the yield on LPs of Uniswap pools circulate through the system. And now, if there's going to be a yield on Uniswap, Uni token does change the equation. It's a large market cap. And where does the Uni token end up? The same place that every token in the crypto market ends up, in an LSD, in a derivative, which gets packaged and the yield gets propagated. It is a big price move for Uniswap. If you didn't see it, it's basically right on the 3-month time weighted average price. This is a big repricing, so apparently the large vested interest in Uniswap, or the persons and actors that want to become vested interests, took a big piece. This is a very big market cap protocol to move 50% in a day in crypto market cap sizing. So it's not something to chase. It ends in the same place. Why? Because if it's 50%, people are going to buy it and dilute it to 20%. If it's 5%, no one's going to fucking buy it because you can get 20% elsewhere. That's the way yields work. They arbitrage to and from different protocol to protocol to find the yield that makes investing in the protocol attractive enough. It's all an incentive. If you don't see a large enough percent, you don't want to buy it. If you see a very large percent, you're going to FOMO and be like, oh, it's paying out 175%. And that yield's going to get diluted and the price point goes up. So what I like to do in my mental framework is to level the playing field and realize for myself how to construct a portfolio and not over diversify. So that, generally is the idea that came to mind today. The fee switch from shit to cash. And I think, as I've said before, we're very much entering a world where the structure of the system is changing and the resurgence of value investing, and I'm buying something. What am I getting for what I'm buying? I don't go to casinos. When I do go to casinos, I I buy like $50 worth of slots, and I end up making like $300, and I'm out. I it's just the funniest thing. That's just a quick little segue. So I'm not much of a gambler. I don't like to gamble. What I like to do is invest. And if you're buying assets and businesses that aren't paying you, that aren't offering you a value, invest in us. We're going to give you this in return. You're a gambler. And that's not necessarily a bad thing. Degeneracy is a bad thing. It's not healthy. Gambling addiction's a bad thing. It's not healthy. There's a lot of unhealthy shit that humans do, a lot of sickness out there. Look what goes on in Vegas. There's a lot of sickness out there. And it could be enjoyable if you could control those temptations. Um, I guess the overall point I'm trying to make is just to inspect these assets, to inspect these moves, to inspect the structure of protocols and understand what they are and what they offer, and not get suckered into not get suckered in. I don't think the market is going to have a very large upward move for a period of time. There's been broad weakness, haven't been able to get. We got, in fact, it was like a double top at like 57. So pre-ETF, it was 57 for Bitcoin. We got back up there, 57, 58, and then we're down at 50. So there's a lot of support still from the flows, but I don't think we're getting back up that high for some time. Just general weakness, and we'll see a lot of chop in Bitcoin. Ethereum went over 3,000 a couple of times, but there's very short periods of time. We see a lot of chop. So when you see these outliers making these 50% moves, they're going to get chopped to bits. I mean, look at the run that Tia and Dimension had, and where are they now? Tia was up at 20, is down at 16. That's a big difference. That's a big drop. Dimension was up at 8, it's down at 6, down 11% on the day. So you see these big moves up. That's the last time to buy it. That's the worst time to buy it. That's the time you never buy something. You don't buy when it's moving. So then that this is exactly why you need that rationale and that thesis, that strategy or that game plan and what to buy. It's not it's not dependent on price. You're not buying because of price. You want the price to move after you bought it. And you don't want to buy because of price, especially a price move. There was no reason to buy Uniswap in October of 2023. It offered nothing, and now all of a sudden there's a fee switch. So there was no rational way to gain exposure to this 50% move. If you zoom in, let's see if there's any structural indicators. I mean, rejected from the 50 SMA on the weekly, rejected, breakout above the 100 SMA, retest. All right, so you have a breakout, a retest, and the higher high. So you could have bought at 8, rode to 11 if you were ultra rational. You could have bought at 5 and change if you saw the wick, the expression of resistance flip support. Maybe a couple of days early, maybe in January last month. So maybe you're an insider, you knew some talks, knew some governance talks, and you saw this potentially coming up, and bam, the market phobos. This is classic for the crypto markets. It's not special at all. It's as simple as that. Can't believe Nvidia is still going up. That's crazy. Gold, I'm retracing a bit, 8% down. Alep's on my watch list as well, but I don't want those types of cash. I was thinking about an Aleph node, which was interesting. Not something I'm actively pursuing at the moment. But as for cash, the portfolio remains pretty steady. Ethereum, Bitcoin, and some random stuff that from claims, from revenue and yield that I'm not selling because I'll sell it at the end of the year when it's worth 10 times as much. That should be interesting. You got Fractal coming up at the beginning of March, so like 2 weeks away. It's pretty interesting. So this is when I see days like this is a reminder to just sit back and relax, and there's not much to do. If you have extra cash, you're probably still late to a position. It's not early. Solana back under 99, but it does look like support. If weakness continues for a couple of days, you're going to breach that 10 SMA on the weekly pretty easily. And there's literally no support on the monthly at all for a long time. So I don't think we're getting this kind of retrace on Solana down to a 40. That doesn't really make much sense considering general interest in the protocol or the network since the beginning of the year, even 2H 2023. I don't think we get that kind of retrace, but I think no reason we can't get back to 90. In fact, there was never a time weighted average price mean regression on the weekly. All of Q4 and Q4 2023 and Q1 2024. So mean regression sounds reasonable. But this will be a cash position. Maybe I would diversify a little bit of Ethereum into Solana. Why not? Albeit there's much more support. You go out to the monthly, no, not much more support on the monthly. You can still have big mean regressions on Ethereum down to 2,300. It's a fair amount to 10, 20%. Yeah, 20% give or take. It'd be a large number. Dan's in the house. Asarko's in the house. Do you think Timeless Money can do something to benefit from this potential upgrade to Uni? Yes. Yes. The yield flows through everything. So maybe, I don't know. I don't know what they would do, but yes, this Uniswap is large, and it's a large market cap for the Uni token, and a yield all of a sudden showing up there will change the structure of the system, and that's what we inspect here on this channel is the structure of systems and the ripple effects, the causality, the knock-on effects that occur. I don't know how the fee switch is going to negatively affect liquidity providers. It has the vast majority of liquidity. It has the vast majority of volume across the crypto space. But if the revenue for LPing is marginally less, like 10% less, it's meaningful and it will cause an adjustment in behavior. A lower percentage number will adjust behavior and cause people to do different things. The incentive system is changing. So it's very interesting. That's about it. Still some drops coming through from Osmo and Atom. Haven't seen any drops yet from Dimension. Something to sit on. Take your time. Did I lose connectivity? Let me make sure I didn't lose connectivity. Oh, I lost connectivity at the YouTube level. Did it boot me out? It booted me out. 1 second. I'll be right back. Oh my goodness. I can't even tell if it booted me out. I have absolutely no access. Sorry, guys. What happened here? Oh, that's weird. Give me a second, guys. Let me see if I can get back in so I can hit your comments. In the meantime, throw up your comments. Let's talk about the market and see what we can understand. See what I can help you with. Uh, what's going on here? Oh, I'm back in. I think I'm back in. Sorry, guys. I'm multitasking here, trying to get back in. Channel. Could something work today? The problem is I can't tell if I got booted out of the stream. Oh, 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 I'm back, I'm back, I'm back. I figured it out. Thoughts on cycle top date range. Top is not what interests me, Patrick. It's bottom that interests me. Top date is going to be after the rate cuts. So the path, we could easily see credit events still. Commercial real estate could cause contagion in regional banking, especially after the BTFP gets canceled. And then they step in with artificial liquidity, which would adjust the path. If they bail out the regional banks from commercial real estate, then we could easily see a path that doesn't have like a systemic credit event because that changes the psychology that's circulating through the system. They will intervene. They did intervene. Moral hazard has been taken out back and shot. So all of this, all of the potential things that could blow up in 2024 lead to the flip in the system where you have capital flowing from the dollar into emerging markets. You'll have the Japanese yen bid And that historically, if you look at the yen, when the yen starts to get bid, risk assets, the dynamic changes and investments start getting pulled out of U.S. assets and start to go overseas. So it's something to understand, but looking at the structure of the system from the U.S. bond market and yields, and it's very different this time. Debt to GDP is very different right now compared to historical situations. There is a great potential for things to play out not as they've played out before. Now, there's things that are different and there's things that are the same. Exuberance will be the same. You're going to see crazy euphoria in the crypto market as always. You're going to see blow off tops all over the place. Bitcoin's going to run wild numbers. Ethereum's going to run wild numbers. And then it's going to crash. It always does because people are going to capitalize and reap them capital gains. But that doesn't happen until particular condition. The particular condition is heading into probably Q3, Q4 2024 combined with rate cuts. And then a period of time for the rate cuts to hit or to propagate through the market. So in fiscal 24, they have to issue $10.8 trillion plus deficit spending. Let's say in a rough $13 trillion of bonds are going to get added to the market, brand new bonds. That's money. Dollars aren't necessarily money as I define them nowadays. It's a currency useful for settlement, but the money is the bonds because the bonds are used to print dollars and not at the Fed, as everyone says. Money print to go burr. That's not quite the story. Bonds are used as collateral. Collateral is a debt position. A collateralized debt position creates credit. Credit is cash, and those debt positions can be looped and leveraged to produce multiples of cash from a single collateral instrument. 10, 20, 30, 40, 50 to 1. So if they're going to print, let's say, $13 trillion worth of money in 2024, what's the purpose of collateral? What's it used for? It's used to print dollars. And sure, when you see money printer go burr at the Fed, that's because they're using it to print dollars in a process called monetization, and that's because the rest of the world is not able to monetize the bonds for us. So the Fed ends up doing it, and that's only recent history, 15 years, give or take. So I expect some degree of monetization at the Fed. They're going to have to provide confidence to the market. It's all a confidence game. So if the international community is not able to absorb the massive amount of bond issuance for fiscal 24, the Fed will have to provide that liquidity for Treasury fiscal policy. That's going to way it's going to play out. They hope they don't have to. I don't see how they're not going to need to. I don't see how the damn rest of the world is going to be able to absorb 13 trill. It's going to be a very interesting year. So what happens? They print the 13 trill. A large portion of it, if not hopefully all of it, goes international. And in international markets, it's all a matter of rates and balance sheet capacity. So when the rates start to come down at the Fed level, which causes knock-on effects to the rest of the world, and rates offered by foreign central banks and foreign commercial banks, it changes the incentive system to turn those bonds, those money instruments, into liabilities at international banks, at not the central banking level, but at the commercial banking level. They're incentivized to issue credit using collateral. So when all the conditions are right, fiscal 24 heading into 25 is going to be the largest increase of currency supply on the planet in history. Understand that. They're about to issue more debt, fresh collateral this year and next, heading into next year, than they did in 2020. And that's obviously because they have to refinance a good portion of the debt issued in 2020, but they also have the broad refinancing of the overall national U.S. debt, 2020 plus broad refinancing plus fiscal 24 deficit spending. And they're not going to cut back on deficit spending. The debt ceiling is on pause. This is going to be a larger amount of money being added to the system than in 2020. Now, you got to also understand that the nature of investing is changing, the yields through the system are changing, so the types of investments that will attract money is probably going to change also. That's in good part like a commodity super cycle type conversation where value and resources and manufacturing and refining start to take a capture more interest as compared to just number go up on stock, and I think that is a big part of what is changing. I think with higher interest rates, so we're at five and change, and they drop it to what, three and change. I think that 3% compared to 0% is going to cause a meaningful difference in where investments are made and how investments are made, or what is even a viable investment. And I think the yields are going to be very attractive, not just in meat space, but in the crypto space. I think the crypto space expands multiples. Well, we get up to $1 trillion of on-chain dollar liabilities by a combination of exogenous inflow, USDT liabilities flowing into the system from external collateral, RWAs, and on-chain endogenous currency creation processes, CRV-USD, Frax, MIM, Abracadabra is going to be hot at some point. It's just the CDP, and people are going to leverage and degen the shit out of it. It's what they do. So there will be a great expansion, and that expansion is going to be very interesting. So my mindset really is from a next cycle mindset. So I try and think about 2025 in hindsight from 27, 28, and I think we're going to see a big expansion in the overall market as compared to obviously 2020 and 2021. Most importantly, from a currency unit perspective, and that perspective is seen best or easiest on the DeFi Llama stables page. Nice line chart. Yeah, we'll see that up at a trill. Why not? We'll see it higher. It's gonna break higher highs at some point. And what does cash do? Cash buys things from a capital gains perspective, but it also invests in things. So as this line starts to go up and breaks a new higher high, that's where we're going to see what the market is becoming. And that's what's most interesting. The market, you could try and get a sense of where the market is heading, and that's why we talk about structure all the time. But the market will tell us what it's doing. And I expect my thesis to play out, that's where I've made my bets. My bet is that cash flow and yield and investments, not gambling, is going to take a bigger part of the pie. And that's very interesting to me. So I hope that helps, Patrick. Thoughts on cycle top date somewhere in 2025, and we'll see it when we inspect things like the DXY. We'll see. Don't talk about Fed funds rate. That's not what you see. That's a lagging indicator, if anything. The Fed is responding to pressures in the currency market. You'll see it in bond yields. You'll certainly see it in Fed net liquidity with their balance sheet. We'll see. It'll be interesting how the RRP plays out in 24 and 25. Didn't exist, pre-2020, early 2020 when they launched it. The Treasury General account is much higher than it historically has been. I think that'll just be, like a constant, talking from an equation standpoint, relatively constant. Keep it at 6, 7, 800 billion, something like that. And I don't think the RRP is going to drain much, but the balance sheet, I don't think it'll drain much from here. But the balance sheet is going to be interesting. They're going to have to monetize. I don't see how the whole world absorbs all of the issuances needs to occur in 2024 and 2025. No horns, no tail. As I understand, the fee switch is only for the front end. Oh, that's even worse. That means this is even more of a stupid move. That means it's a move based on nothing. And it's their front end. The vast majority of their activity is not from their front end. The vast majority of the activity is from their contracts from third-party protocols. So this just shows you that the market latches on to any idea and tries to front run it. Hype. The modularity, the roll-ups, dimension. It was hype. It was all hype. It was exciting. It's the next big thing. And it's big. It's big tech. It's meaningful. But hype fades. And it fades really quick with regard to price point. Which means I'm much more interested in the lows. I'm interested in Bitcoin blows off to 250, 300, 400, 500. I would not be surprised to see it crash to 60K. And that would tell me much more information about the structure of the market heading into 2027 and 2028. There'd be a bit of consistency because if you go back into November of 22, 15, and 2018 highs was 20,000, give or take. 25% below previous all-time highs. So let's see 60K. That'd be interesting. 50K. So I don't think the next low in the market is much higher than where we are, interestingly enough. Tells you something from a premium versus a discount standpoint, and Bitcoin investing versus just Ethereum investing as well, just cash position management. Let it blow off and you got to sell it. You got to manage it like an FX portfolio. It's just what you have to do. It's not an investment. It's the cash part of the portfolio. Hope that helps. Um, Bain Ruga. I got you. FX protocol is seeing FXUSD. Yeah, I have a high opinion of the Aladdin DAO. It's such a broad suite of products. The amount of convex that they own is ridiculous at the cleaver level. The amount of deposits at the concentrator level is crazy. And the product offering from an LSD perspective of the F of X F of X level is big. It's a big deal. Um, LSDs of Ethereum are just going to keep expanding, and their stablecoin has a capacity to probably garner a lot of attention and create multiples of the depth of their current LSD supply. Very interesting. How do you have exposure to that? I don't know. It's a hard question. Do you choose the FXN level? And for myself, I wanted the beta play on that. And you have to watch position size. Can you acquire an adequate position size? And for me, the only thing I can accept that I could purchase enough was at the concentrator level. I couldn't own the amount of cleaver I would want to own for it to be a nice size position for the portfolio. And that's acceptable, and I was disappointed because I kind of would rather own cleaver. The voting power at the convex level is a big deal. Um, but I couldn't. So what I know is if Aladdin's stable is a big deal and their LSD continues to expand, the same thing that happens with Uni will happen with everything else. Everyone will look for what's the next thing, what's the next thing, it's all people do. It's so shallow and such a trivial perspective to have on managing your capital, but that's what happens. So FXN rips 10x on the money. And there goes Cleaver, and there goes CTR, and then the tokenomics upgrade, and there goes ALD, and then it's all recursive on each other, and then it's like, oh, investing. And everyone remembers how do you invest. And then you look at the yields, and Cleaver's putting out less than 10%, and this thing is cyclical, but it gets up to above 15% at times. So I think concentrator is just look at that TVL. That's crazy. That's a massive amount of TVL. Okay, so I just see it as mispriced. That's my 2 cents. Um, no horns, no tail. You still saw me. That was just client side for YouTube Studio. I wouldn't be surprised if we get banned for some stupid reason. Can you please talk about the FPIS proposal? Yeah, my mind is as a reductionist. So I reduce it to broadly them condensing, consolidating they want to focus on FXS. So if everything goes through FXS, it simplifies the entire management of capital, the distribution of capital, and that changes the equation from a software implementation standpoint, but also a marketing standpoint. So it's as simple as that. FPI is a very interesting product. It's part of the suite of products. Is it the pinnacle? No, I think Fractal, frankly, is going to be the pinnacle of their product. It's going to tie everything together. And what do I like the most about it is that FXS is the center of the event horizon. It's destined to receive the revenues of the systems, not even system. Fractal has got to be the biggest, broadest protocol of protocols in the crypto space. It's just its suite of protocols is so large in number, still quite extraordinary. So I see that as mispriced. I see it as not much revenue because there is vote rental revenue for VEFXS, but if the revenue for VEFXS is 10%, 20%, that garners a lot of attention. The FXS reprices, and now the yields from their gauges go up, and that drives in vote rentals. So it all compounds as everything expands. So the potential is quite big for VEFXS to go from a marginal revenue producing investment to a meaningful revenue producing investment. And now that the whole equation changes with regard to people, how they look at it from an investment standpoint, not from a speculative price action standpoint. Hope that helps. Tape Pusher, my man, thank you very much. Hilda's in the house. Always a pleasure. Ben Ruga, think you like seeding event Lido Frax are putting incentives on the seeding and FX also in the Medium article. Lido's doing well, by the way. I don't fully understand the comment, but that's okay. Lido structurally is in a good position. No lower low. Reminds me of like a sys chart. No, not a sys chart. Reminds me of an atom chart. No. Is this log on? Reminds me of an atom chart. So up, higher low. Not really at the higher high. Then you go over to atom. Why does it keep doing that? Yeah. So up. This didn't break out yet. I know, that's the whole point. You want the higher low. You want the resistance flip support. And you want the higher high. So there is still discounts in the market. It depends on how far you can look into the future. I still have a high opinion of Atom. It's under pressure. It's below the 200 SMA in the weekly. It's below the 50 SMA on the monthly, hovering around the time weighted average price. Looks like the 10 SMA on the monthly is decent support. You know, you get a confirmation with a breakout above the 50 SMA, $14, and that locks in obviously 10 SMA time weighted average price on the monthly as support, and that's certainly a resistance flip support because we've held it as resistance multiple times. Then you flip it, much like this, then you flip it as support, and you print the higher high. So this is when you buy products. I'm not endorsing buying Atom, but you buy products before they rip to the damn upside with the candle. You just that now you have to question how are you looking at products? How are you choosing products? The down, the breakout, the retest, and the higher high. So let's see where this goes from here. Higher high. Higher high. And that's how the staircases work until it flips, until support flips resistance. But I don't think we're in that type of position in the market. I want blood. Ethereum is annoyingly expensive. Yes, it is. 29.35. It just won't go down. The damn asset just won't go down in price. It looks very healthy. It's a very healthy chart. So we were looking at Lido, higher low, higher high. And but look at this higher low. That is a much. So this is obviously a cycle beyond, but there's a much higher low. Higher low, higher high. Low, high. So the complexity from these time frames is it's multi-year. I don't look at the short-term time frames anymore. When you see the higher high in end of Q3, Q4 2024, it's multi-year. Lots of candles, lots of patience, which means you really it's not about conviction. Conviction is such a generalization. You have to understand your portfolio. You have to have a pulse on your portfolio, feel your portfolio, have a sense of its construction and what it means, and have a vision of where this whole system is heading into the future. Hope that helps. 25 seems like the perfect storm for those who hold assets. There's got to be a catch. Yeah. I expect the next bear market, structural bear market, likely to be in 2025. Something breaks. Something explodes. Yields go too high, or yields are too high. And the yields being too high for too long catches up and blows something up. But that process often takes a year or two or three. It takes time, big time frames, and you have to have the foresight and the patience to let those time frames play out. Delete. Hola Cap, Diego's in the house. Buena tarde. Gusto verte. Oh, a lot of comments today. Let's do it. Amen. Hi, Cap. Once you said you don't stake your ETH, are you not staking ETH because you're already positioned in protocols that give you 20% plus yield? Is risk the primary factor for you, or is APR? Okay. I believe the yield is marginal, and I don't need the 4 or 5% on my cash position. The investments are really what I focus on for income, not yield on cash. So I treat it as a cash, which means I will be selling the top for Ethereum and Bitcoin and anything that I hold liquid. There will be a point in time where anything not nailed down will be sold. Therefore, you probably want to sell before everyone else sells it. So we will be talking much more from capital gains from a trading perspective when it comes time to rotate the FX part of the portfolio, the cash part of the portfolio. But now's not that time. Now's a time where the volume is just accumulating, where things that I need to claim, and the income I get that I cannot say no to, like a vote market on Curve. You have to claim it. Uh, Put it in cash, either an Ethereum, a Bitcoin, or stable coins, depending on what you need. And and once the portfolio gets large enough, I'm speaking from the perspective of, yeah, I want to have some cash, stable coins, so I could service bills and pay for things and live, so on and so forth. You don't want everything to be in a volatile cash position. So cash, therefore, is Ethereum, Bitcoin, stablecoins. Solana could be a cash. Great. Have it part of the cash portfolio. Anything liquid. Stargate up at 65 cents. Pretty cool. Hope that helps. So I don't need the it's a marginal yield. I'm not too interested. It's not see, look, it's not enough of an incentive. It's not enough of a yield to incentivize my behavior to stake it, considering what I use it for, a cash. Um, What kind of scale do you think f of x protocol can reach? Similar Q regarding Prisma. My man, it's a 4 mil market cap. There's no reason for it to not reprice 10x. And it's a 40 mil market cap. The whole market is going to reprice so many multiples after 13 trill of money, and you put 10x leverage on it. You're talking about like 100 to 500 trillion dollars getting added to the global liquidity pool of currency units. It's going to be disgusting at some point. It's just the way the system works. It's the actual mechanics of the system. So, see, the thing is, if you get paid 20%, it's much easier to sit on it. That's the complexity, and I'm sure you could appreciate that. But we had a nice conversation on Discord about round tripping and opportunity cost, and is it part of your cash position or is it an investment and it's producing yield. I think that's a good equation. So if you treat it as a cash position, I see it expanding as well. I see exactly what you see. It would be awkward for it to remain at this market cap considering the products it offers. And if you apply that to a time where there's 5x more liquidity in the crypto market, stablecoin wise, it's going to reprice. And then we'll see the contraction in liquidity in the markets. We'll see stablecoins start to roll over. I have it. Come on, I have stablecoins somewhere. I mean, just look at USDC plus USDT on a trading view, and you'll see it roll over. You'll see the redemptions, and and that means the liquidity is draining, and things will sell off. And that's the top from an FX perspective, and that's when you rotate your cash from volatile to less volatile. Diego, not serious question. How to become millionaire in 10 years? Give us your tips. 3 cycles. First cycle, you lose everything. Small portfolios need to take risk. So you need to trade. You have to start to understand technicals. You have to start to understand social trends, inspect social media. You want to find the breakout, the retest, and the resistance flip support. So you need to understand technicals, and then you have to understand confluence. So you combine the technical positioning with the social media trend, and that flip of resistance into support combined with the social media, there's your breakout. So you ride the trends. Smaller portfolios, 50K or less, you need to get those multiples. Charlie Munger used to talk about get your first 100K. 100K at 20% is $20,000 a year. That changes most people's lives on the planet. That 100K in the right asset reprices along with the market. 10x turns into a mill at 20%, 200 grand a year. First 100K is the hardest thing to get. I agree with Charlie Munger in that regard. I obviously don't agree with his investment analysis, and clearly he was very successful in every regard. But everyone must find their own path, and then they will have their own story to be able to tell you these types of things like I'm telling you right now. Because it's very consistent with my path. 3 cycles. First cycle, you don't do very well. Second cycle, you figure out how to get some multiples. You figure out some technicals. You start to see the social trends, and you're able to multiply the portfolio. And then at the end of the cycle, you give it back a lot. Third cycle, you get the multiples, and you give back much less. Much less. And that's exactly why we're talking about rotating the FX part of the portfolio, treating it as cash, looking at liquidity, FedNet liquidity, looking at not M2, too lagging, but looking at the move indicator. That's a big indicator. It's a very forward-looking indicator. If you look at so many other charts compared to the move, when this thing bottoms, when you see a spike up in the move, shit's going to get spicy. And you'll be 3 months early, and that's okay. If Ethereum rips to 30K and then the blow off top is 38, sell the damn thing at 30K and miss the last 3 months of the move because the move indicator spiked. And stick to that religiously, and that'll make a big difference in your capacity to make multiples at a smaller size portfolio, how to protect the value of your cash position at a larger size portfolio and a more structured portfolio. Hope that helps. Trevor Van Meter, my man in the house, how are you? Asarco, can you talk about your assessment protocol and tokens that may be mispriced? What should we be looking for? Now, I might not be right, but I look for confluence, and I might not be right. I might be wrong about CTR, but 57 mil TVL means there's an offering, a service of the protocol that is attractive. So That's clearly mispriced. If the market cap of CTR is like $1 million and it has $50 million in deposits, it's literally like looking at a restaurant down the street that has lines out the door and people ordering in and is making millions of dollars a week in profit, yet it's valued at like a half a mil, $1 million. It's a mispriced valuation for the business that's generating a huge amount of revenue. And it's as simple as that. So you could diversify in that regard. So you find these mispriced assets looking at attributes, technical details about a protocol. And if you have one, two, or three of them, you can have a relatively small position, and that mispriced asset now becomes properly priced. And in crypto markets, a mispriced asset becoming a properly priced asset, it's not doubling your money. It's 10xing your money. It's 50xing your money. And you can have a small part of the portfolio. 1% of the portfolio to 10% of the portfolio changes the whole structure of the portfolio. That was a core thing back in 21, 22. We talked about that a lot. Even 0.1% of the portfolio to 1% of the portfolio changes a lot. So that's just, rules of wisdom to keep in mind. Larger market caps are harder to assess. Like, how do you assess a 200 mil protocol becoming a $2 billion protocol? I'm not too fond of the mainstream adoption as a point of confluence. Like, is big tech, Aleph, and on-chain Python and on-chain Linux with Cartesi. It's massive, massive narratives. I mean, look, even Filecoin and data availability like Celestia. That's like, Azure, Microsoft Azure, and AWS file storage. I don't see those systems being disrupted in the short term. And I don't see, $2 billion assets getting repriced to $20 billion assets for a 10x. That's not where I want to get my 10x's from. I want to get my 10x's for something that someone doesn't understand, something that some people don't understand. Mispriced small cap, micro cap, pink sheets, if you will. And for me, the thing I understand the most is cash, is money, is credit, and how the monetary system works. And that's the biggest thing I see in these crypto markets, is the credit systems. It's bigger than all of it combined. Talking about the banking system, talking about hundreds of trillions of dollars. Not just data availability, not just AWS and billions and billions of dollars of revenue. We're talking about banks that have trillions and trillions and trillions and trillions of dollars of deposits, and people borrowing trillions and trillions and trillions of dollars. It's a whole other scale. So that's when I look at these credit protocols, those folks are going to at some point find these systems interesting from a regulatory arbitrage perspective, from an interest rate arbitrage perspective, from a geographic arbitrage perspective, from a capital flight perspective. Get your money out of China, get your money out of Russia, get your money out or wherever you feel that your money is at risk. From a risk arbitrage perspective, people look at the crypto markets and see risk. I see actually resolution to risk in many regards. Very comfortable. I've been very comfortable, and we've been very comfortable in these crypto markets for a long time. I find comfort in the CVX. It's not new and shiny, but it seems integrated and established. Tay Pusher gets it. That's why we were just talking about comfort. The amount of governance control that Convex has is extraordinary, which means if any of the protocols, any of them, do well, Convex does well. I like protocols that have deep tentacles, deep networks, a federation, if you will. Because if any one of the protocols in a network of protocols does well, they all do well. And that significantly reduces or it increases the surface area of potential success. That's the part of the narrative that I have for this CTR position. If F of N does well, if Cleaver does well, this will do well, merely because it's part of the family of protocols of Aladdin. It's really as simple as that. At least that's my narrative. And you're not always right, but you don't need to be right many times. All you need to be is right one time big. And that changes everything. Given FX protocol is going to the B2B route with incentives from other protocols for rebalancing pools, in my opinion, FXN was the way to go for me. Sure, and I know the price that you bought it at. You got it at an appropriate price. Let's look at the chart. See, a lot of folks would zoom into the hourly chart. Zoom TF out. If you were in here at the $15 level, you're fine. $20, $25. High or low, it didn't. Look at these wicks at the bottom. That's lovely, lovely hammer candles. And if it retraces to 30, 40 on a big capitulation, you got the price point. You got the 13. That's great. That's lovely. If you could get OTC deals where someone is willing to sell you at a completely mispriced level, you take them. That was the solidly play. It's doing not well compared to any of the other V33s, but someone literally sold it to me 90% off. Okay, I'll take it because it's a punt. It's a 0.1% of the portfolio goes to 1%. It changes everything. The 0.1% of the portfolio goes to 10% of the portfolio. Holy shit, jackpot. So small bets, asymmetric bets that could pay off big. That's how you change the portfolio. So this plays into portfolio structure, diversification, avoid excess diversification, favor concentrated positions over excess diversification, obviously, find what's mispriced, and be patient. You know, folks in Discord and with me on the stream for all these years, especially in the last 2 years, I've taken very few positions. I've been very methodical when choosing to do something, preserving capital and acquiring things only if I could get them at a discount. And that's it. Simple as that. Definitely not FOMOing anymore. Bear in mind, it's my third, fourth cycle, give or take. So that's where I'm at mentally. Completely agree. Aladdin DAO will come soon. I got an early FXN 1417, small wallet size, still around half my portfolio. 1417 means you could just sit. And for it to get back to 1417, you're literally talking about a failure of the protocol. Something happens. Otherwise, LSD, stablecoins, big tech, multiple protocols. It's very interesting. So what matters there is the right price. So historic pricing is a bias, meaning I'm biased because I have access to historic pricing. Go from 90 to 900 and then crash to 160. So clearly from an FX perspective, a cash position, that's interesting. But the way I don't necessarily take my resistance to consideration as the end-all be-all in the decision-making process. Just because I don't want to ride it from 90 to 900 and then watch it crash, in 2025 down to 140 from 900, doesn't mean that's not a bad thing. You just have to watch the global liquidity and you treat it as a cash position. But I want it from an investment perspective. So I use things like this, historical bias, to invalidate considering it as a position. I don't need it. I already have a portfolio. I have a great portfolio that's going to do extremely well over the next 2 years. I just don't need it. So in my position, the only reason I would take a position is if I could get it at a freaking ridiculous price. And that's what Warren Buffett historically talked in terms of. You're either getting at a fire sale price, something that's ridiculously mispriced, like just something is getting liquidated and everyone, the price is getting destroyed, and meanwhile the company's making $50 million a year in profits. That's mispriced. So that's not where we are. We'll see that in 2025. So that means you got to stack the cash in 2025. The cash doesn't mean dollars. So you got to play the FX and accumulate as much cash as you have. Sell it as high as you can. We'll watch global liquidity. We'll watch the move indicator, the DXY. Watch the bond market. We'll be early. Won't catch the last part of the move, the meat of the move, so to speak. But we'll have the cash to be able to buy shit that's mispriced in Q4 2025, Q1 2 2026, and we'll be able to buy some discounted, mispriced investments. Hope that helps. Hey Cap, interesting dimension. Just got USDT available via Kava. Cosmos hubs are a whole nother world compared to 2020 and 2021. It's very interesting what's going on over there. And I have all the exposure I need between Atom, Osmo, and the dimension drop. It was a very large airdrop. I don't need any additional exposure. So obviously, I'm not very helpful in those statements. I'm obviously speaking from my perspective, but I have a high opinion of what's going on over there. I think it's a, proto-emerging market, has basically microscopic dollar liquidity. You're talking about USDT on Kava. It's small. It's smaller than Phantom. Basically marginal. Everything other than Solana and Arbitrum has basically no liquidity. Even Avalanche is small. So keep these things in perspective. So all you need is small positions on Cosmos and give it 8 years and let everything reprice. Where it's not a small market anymore, it becomes a larger market. And Polkasop's trailing Cosmos. That'll take some more years to really become what it can possibly become. Hope it helps. Greetings, Captain. What would you do as a European sideliner? Very different considerations. Very similar. Same rules. Sidelined. What cycle? First cycle, second cycle, third cycle. If sideline, I speculate first cycle. Think in terms of cash. You're going to have to understand technicals. There's not much at a discount, which means crash positions are probably not going to be much higher than where we are. That's what I was talking about with regard to Bitcoin. So this is broadly what I expect Bitcoin to do. It's short term. It goes sideline. I mean, literally, I'm on the monthly. This little white line right here is end of 2024. So let's say 250, and then it crashes in 20. Look at that. It's hard to draw on the monthly. That's all the way into 2026. But this looks about right. That's a hell of a move. 61,000 as a bottom for Bitcoin from the bottom in February 23 at 15. That's a 400% increase in the price of Bitcoin in 4 years. That's on average 100% per year. That is a massive, massive move. So, then you could do shit like this and just say bullshit, bullshit, bullshit. This is all bullshit. It's all bullshit. The tops don't matter. The tops are going to drive you nuts. It's the bottoms that matter. That tells you what kind of market you're in. Bullshit, bullshit, bullshit. It's going to be a long journey, Snoke. Small portfolios, treat it as cash. You got to process it as FX. You have to understand global liquidity. You have to follow the DXY, the move indicator, and the United States Fed because they create the money. Or the Treasury creates the money, they create the bonds, but the Fed tells you kind of how the money is going to be used to create currency, to create the dollars, how on the defensive they are. And the more defensive the U.S. money situation is, the more dollars will be supported in the market. And as the Fed steps in to support the dollars in the market, that just kills the moral hazard, and it affects the sentiment of the market to get frothy because you feel like you're protected. And that just changes the whole investment equation when you have that kind of intervention. So we'll know more as things play out in 24, 25. Early portfolios, early new investors, dollar cost average always is an interesting approach, but it's a long journey to really have a second sense, a sixth sense about how these markets work. I am much more comfortable in these markets than I am in stock markets. This is the place where capital is made and also where capital is protected, in my opinion. I've never, there's, I don't, there's nothing like these markets. Hope that helps. No hordes. USDT can now be held on Dimension. Yeah, Dimension has their liquidity that they've set up. It's pretty cool. IBC is crazy. I remember when IBC launched. Nobody said anything. Nobody said anything about osmosis, and it was a massive airdrop. And no one said anything about IBC. And seamless cross-chain was literally the narrative in 2021 that I posted, Q4 2021. Seamless cross-chain liquidity changes everything. At some point, you're not going to know what chain you're doing things on. It's just you're going to be on whatever chain you want, and the protocol is going to go to all chains and get all the liquidity and give you the best prices and give you the best interest rate on credit. You could literally have an Ethereum protocol that's using Celestia for data, and maybe it's hooked into, if they have the cross-chain contracts, which is what Layer 0 is building. You connect over to Syscoin and interact with Cartesi for Linux VM functionality. Oh my God. So the future is going to be very interesting. Brian, much a pleasure. Welcome. Snoke, where do you see these markets going on to 2023? What do you think about the market cap ranking of these types of time frames? This is all I think about. In fact, nowadays, right now, my mind is primarily in about 2027, 2028. And I like to think about that time frame because I think of 24 and 25 in hindsight. I like to think of that backwards perspective. And it's becoming clearer. It's a binary bet. And you never bet on the world collapsing. You never bet on Mad Max because then you need guns and ammo and meals ready to eat and canned foods. So that's actually pretty easy to do. You don't bet on CBDCs coming online, and then they just take everything, and it doesn't matter anymore. So that means, from a binary perspective, the behavior we're engaging in right now makes perfect sense. It's either this works or it doesn't, and if it doesn't, there's nothing to bet on. It's going to become totalitarian, and it's the only way they'll be able to control society and keep civil order. That's what this whole thing is about. That's what all of politics is about financing social order. So 2030, you could see another cycle. Oh my God, what, 20 trill comes out of the Treasury? Fed balance sheet is at 20, 30 trill? I have no idea. Raoul Pal does these types of projections out into the future. And we could see those kinds of expansions of the global money supply. And you could see Bitcoin, tops at 250 this cycle, a 5x from here, crashes to 70, 60, and then runs to a half a mil, 750,000. And then it crashes to 100, 100 and a quarter. Okay, and all that sounds quite reasonable. Bottom for Bitcoin, 2030, 150K, 125K? That'd be interesting. So 150, 125K, and the bottom here in 2022 was 15, about 50, let's say 15K. So 10x on the money heading into 2020, 2030 from the bottoms. Interesting, because a 10x heading into 2030 in crypto terms, that sounds reasonable. And we're not talking about the tops, because the tops are just get disgusting. Remember the circles here. Bullshit, bullshit, bullshit. All this is bullshit. Folks engaging with the markets that don't understand the structure of markets and the cyclicality of markets. This white line here, this line right here, is the secular trend. The lows. And that tells you the structure of markets. Cool stuff. No horns. Henny, how do you view the numbers behind a company's business model, say CTR? I know some protocols post balance sheet, but no, not on Medium. Um, Most of the time, it's very public. You know, Frax has a great balance sheet presentation, but that's not the same type of inspection I'm making. The fact that they post their balance sheet is insane. That just literally adds so much icing on the cake for what I see as them being an actual well-structured business. It's crazy. Um, but you look for deposits. TVL is misleading. You look for stablecoin capture. Where's the stables? Oh, it so happens that the good part of the stables, if not a majority, are on Curve. Why? And the answer is in itself. They're there because that's where they feel the most safest. And that means everything. So you look for these types of attributes to understand how the behavior of people engaging in crypto, what it means. Um, it's not a balance sheet, a traditional balance sheet from a corporation, but you're looking for the attributes of the protocol. Uh, obviously early, you want the audits, max risk, max return. The earlier you are, but deposits are meaningful from an exchange perspective. An exchange is an exchange though, right? How many frickin' exchanges can we have? So in some regard, I see exchange saturation. And what happens every time a sector of the industry gets saturated? Everything condenses and collapses. That's what monopolies are in meat space. And you'll have your outliers, particularly because the crypto space is structured different than meat space. It's an emerging market of emerging markets, so you can have outliers on different chains. But it should condense significantly, especially during uh, the down part of the cycle. You want the quantitative data. So DeFi Llama tells you a good part of that quantitative data. Stables, fees, volume, yield percentages. If it's not a competitive yield, it's not going to incentivize activity. What's a competitive yield in crypto markets for the amount of risk people are taking? I would say over 10%, 15 to 25% is like, all right, that's an interesting amount of yield. 15 to 25% on $100,000 is $15 to $25,000 a year. That's interesting. Hope that helps. Such good thought process you are sharing with us right now. You're very welcome, Stoke. It's been a long road, and we will continue refining the way we inspect these markets. Folks like Dan must be like, this could be an interesting story in 27 and 28, because we've come a long way since 2020 and 2021. Tyler, what do you think about Ondo? RWAs, on-chain bonds, great. Money. They're bringing money from the real world on-chain and printing currency units. Okay, cool. It's part of the equation. A lot of hype. Redundant? Not redundant. They're doing unique things. They have a lot of attention. But they are contributing to the overall liquidity composition of these crypto markets. I already have exposure to the liquidity composition and the velocity of these crypto markets. Plenty of AMM exposure in my portfolio. So I don't need exposure to it, but I mean, it's moved huge amounts. Anyone who's talking about it is certainly late. It's late. I mean, get it at 17 cents. Yeah, literally 20 cents. This is a great price. 40 cents? All right, 100% off the bottom. Food for thought from a crypto perspective, 100% off the bottom is relatively marginal, small. 2, 3, 400%, that's getting there. Anything more than that is just painful. You're buying at a premium. But this is it's a decent premium. I think there's plenty of ways to get exposure to the crypto space in a more um, risk-adjusted fashion. I don't like hype at all. I want to buy things that are not hyped at all. And then you'll start to see the social trends, and they can get hype, so that's interesting from a capital gains perspective. But anything that has hype, I'm immediately just I have all the information I need to not look any further, and that's the case with something like Anando right now. Um, would be so cool if you could comment on these interesting pieces. Which pieces? I'll comment on anything. I don't see the pieces. It's all good. I'm here. Patrick Ford, thoughts on the new model, the block, Bitcoin Power Law. Oh, I saw that. Yeah, it's cool. It's cool. I still like Plan B. I like those stock to flow models. It's just information, and the model's a model. Conversation about the model is subjective, and generally speaking, if the currency supply of the planet expands, the price of restricted supply assets will increase. Look at housing. It's just a simple equation. That's kind of what the stock to flow model is, except it doesn't really consider overall composition and depth of global currency supply. So I much prefer that type of modeling, which is like why I like Mike Howell's type of perspective. Um, so much FUD thrown his way most recently, and that's unfortunate, but it's also understandable. And it's a very simple thing to understand with regard to liquidity. If there's $1 million in cash sitting in front of me and things are doing pretty much upward price action on assets, I'm probably going to want to buy some stuff. So the more cash, the more buying, the higher prices. It's simple as that. So therefore, why don't we look to see how much cash is available? And let's do a step better. Let's see how much cash could be potentially available. So let's understand how cash is made to understand if there's more of the stuff that can make cash, there could potentially be more cash available. And that leads us to the story of how the monetary system works and what U.S. bonds are. They're cash makers. So that's why we want to know how much bonds are in the system, and then we want to understand what conditions are optimal for turning those instruments into dollars. Pretty simple equation. Snoke, I'll help anytime you need anything. Ask any questions. Last question. We're going to wrap it up. Long stream. Jan or Jan. Hi, Noah. Do you keep track of how productive are your positions, which perform better than expected? On average, very comparable. Fiscal 22, 23, on average 25, 30%. In fact, that sounds about right. So I think that's a decent rate for crypto markets. Think in terms of the risk-free rate. You get 5% on a money market account risk-free. So what does it take you to invest? And if it takes you a certain percent to invest, it's going to take other people a comparable percent to invest. So if you're seeing 15, 20%, those are interesting numbers once you have a certain amount of size. 15 to 20% on 100 grand changes everything, because that 100 grand is going to get repriced along with the global currency supply, and the percent return is likely to remain competitive, risk adjusted to these crypto markets. You get a 10x on the portfolio and it's still producing 10, 15, 20%. That's very interesting. And that That's what I'm here for. I'm not here for even the returns this year. I'm here for the returns in 27 and 28 and then 31 and 32. And it's going to be very interesting. All you have to do is set up the puzzle pieces and let time do the rest. And sit back and watch the insanity of people trying to figure out what's going to happen tomorrow or what the Bitcoin price is going to be in a month or when the Ethereum ETF drops, how's everyone going to respond? I don't give a shit. What I care about is the global currency supply. And what I care about is relative scarcity and the risk profile of Ethereum versus Bitcoin and the opportunity cost of Bitcoin versus Ethereum and the potential for tech plays and credit companies and credit. Credit's the biggest goddamn business on the planet. And folks are chasing I don't know what kind of stories at this point. I'm not surprised. It's the same exact thing in 20. It's the same exact thing everywhere. The general public looks at a price point and they're like, "Oh, it's going up. I want to buy something that's going up because I'm going to make money." And then their portfolio is worth money, and they're like, "I have money," but you don't have money because you didn't sell it. So there has to be some rules and some better understanding about this game that people are playing and what they want to play. And what we're learning is how to go from what we're doing and how we understand things to where we want to be. And frankly, I just want to be like a wealthy business owner. All a business in meat space, you have to manage your businesses, and it's complicated. And that's why the crypto space is crazy. If you look at these things in terms of businesses, if you own 10 pizza shops, you're managing the shit out of them. Because if you're not there, the employees you can't ensure that they're being as productive as possible. But in the crypto space, we're talking about deterministic, immutable contracts. So if they're doing what they're doing today, they're going to be doing the same thing in a year, in 5 years, in 10 years. And you, as the owner of the business, you don't have to check on it. You don't have to manage employees. The business is going to be doing it deterministically. It changes the whole equation as a business owner. And that's crazy. Oh, last couple of things. I'll wrap it up. Damn, bunch of stuff just came in, but I'm not going to leave you hanging. Um, 69 Dreams and Delusions from Red Phone Cap Crypto. I don't know that reference. I understand your plan for your cash and your cap gains, but what is your plan for your investments during the next crash? Hold steady, reposition. My investments aren't sellable. They are ownership. They're not positions. If I paid X amount of dollars for them, they are worth zero. Just like if you go into a tech store and buy a computer, you're not thinking about how much is my computer worth if I resell it. You purchased a computer. I purchased my businesses, my positions. They're purchases and not positions. So that's the mental perspective that I have when I think of these parts of the portfolio. My investments are purchases, not positions. Hope that helps. So it's not hold steady or reposition, because that's thinking in terms of stuff that you could buy and sell, and that's not the way I think of the portfolio. I want to buy and own businesses as cheap as possible, and that's the investment part of the portfolio. And the cash part of the portfolio is a lot of what everything you said applies to the cash part of the portfolio. The next crash, hold steady or reposition. That's the way you think of cash. Investments need to have a different mental mental way of thinking about them. And that's how you're able to allow time to play out and do the work for you. The piece in this one is above. I shared the link, but it got disappeared. Yeah, I'm not going to read a piece on stream, but I appreciate it. Stop by the stream 2, 3 times a week, and I'm happy to talk about any topic. I'd be so grateful if you could comment on that piece next stream. Uh, take an excerpt next stream and post a little bit of text in the comment section, and I'm happy to talk about anything that's in the comment section, and I always finish everything that's in the comment section. I recently told my friend about your stream, Noah, and now he watches you consistently. He's watching now, and it's his birthday this weekend. Shout out to Luke, a new Captain Rational team member. Luke, welcome. Much a pleasure. We got to think about things differently because the majority don't win. The majority lose. Therefore, we need a mentality and a strategy that's different. You have to be different, and that's what we do here. You're very welcome. Nine Ergonzola, my man. I appreciate you. Thank you all for sticking with me to the end of the stream. 39 people made it to the end of the stream. That's crazy. 13 likes. I appreciate all of you. Smack that thumbs up button. Please tell everyone to subscribe. Friday, February 23rd at 12:59 p.m. I wish everyone a good day. Link to Discord in the description for the most rational community in the entire crypto space. I will see you guys after the weekend next week. Peace.